We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me is Wallet Watch contributor Bruce Anisi from Open Road Wealth Services. Bruce, how you doing this week?
I'm doing well, Eric. Good to be back with you again.
Glad to have you. And of course, the whole world right now is pretty well focused on what's going on in Ukraine. We're a month into what even all the experts thought was going to be a 7-day war. How is all of this now affecting the markets, affecting people's portfolios?
In a lot of ways, actually. And my friends at LPL Financial, they have a LPL research department, and they put out from time to time equity strategy insights. And they published one just a couple of weeks ago. And I wanted to just touch on a couple of the items that they mentioned in that article. Executive summary says high oil prices from increasing demand and tight supply help support energy stocks in the near term, but there's a lot of uncertainty beyond the very short term. So that's one item that they're looking at closely. Selective exposure to materials sector for building, because obviously once this thing is over, there's going to be a lot of building to restore Ukraine back to what it was before the invasion. They're going to benefit from rising prices in both agricultural products and in metals. So as a result of those two items, they are saying they have a bias more toward U.S. stocks rather than international and emerging market equities. So they go into that in a little bit more detail.
So we've got, energy sector is up, building materials can be up. So at least there are some semi-safe havens for people to put their money in. But of course, we've seen the S&P 500 now hit correction territory.
Yes, absolutely correct. We're down as of today's market about 7% off the high that occurred toward the beginning of the year. And it had been down a little bit lower than that, but it's bounced back a little bit recently. We seem to think that this war is going to be a protracted event. Initially, as you mentioned, it was expected to be a quick sprint to Kyiv, and then the war would stop. Well, that hasn't been the case. So I think there's an expectation that it's going to be an ongoing piece of the news, but at some point there's going to be something else that overtakes it. If it's just going to be a long, protracted thing, then it just becomes part of the furniture. It's just there.
Right. But I mean, even at that point, it's still going to be affecting the markets. It's still going to be affecting, stocks and people's investments. Where do people think the markets are going to go? I mean, I know there's a lot of pundits now saying there's a lot of indicators saying we could be going into a recession.
Among the folks who have commented on that idea is, of course, Jim Cramer from CNBC. And there's a quote that he put out recently. It says, "There are no grave systemic risks to the economy or the country." And then he added this other tagline to it that is an enormous risk, although unlikely, and that being except the possibility of nuclear war. So that's certainly unsettling to even have that in the conversation. But it's not very likely, because that would be a globally devastating event with absolutely zero positive outcome. So
I think we need to be planning our portfolios under the assumption that the nukes are not going to fly, because quite frankly, if they do, we've got bigger problems than where our money's sitting.
Yeah, it's where our backsides are sitting.
Yeah.
Yeah, so that was an interesting quote from Kramer. But the part I took away from it was his take that the U.S. economy is basically okay, with the fact that we've got some inflation that we haven't seen in a very long time. But other than that, the employment numbers are starting to look a little bit better. It's really the global mess in Ukraine that is grabbing all the headlines. And one of the things that's most impactful related to that is the energy sector. Roughly 1/3 of European natural gas consumption and more than 1/4 of its crude oil exports are derived from Russia. So if that flow of energy resources is impacted, then the European economy is going to be impacted. And LPL, through their commentary here, is moving away from emerging markets and some of the international markets as a response to that concern.
So just to summarize, basically we're saying we expect the U.S. economy to be much stronger than the global economy overall, primarily because of these lack of energy and the struggles that they're having due to Ukraine.
Right. What the folks at LPL Research are talking about is that from a pure economic perspective, Russia is the biggest loser in the conflict, and additional sanctions are likely to drive the Russian economy into a depression. Western Europe would be the next biggest loser. So that's why their tilt is moving more toward the US, where we have a strong dollar, and that's going to be another headwind for international equities. And they're not going to be able to keep up with US stocks because of the impact of a stronger US dollar. But one of the things they also talked about is don't necessarily run away from emerging markets, just recognize that there's some additional risk and take positions, perhaps a little bit smaller bite than you might otherwise of those emerging markets.
Absolutely some great advice. And as always, we remind our listeners that your portfolio and your needs are individual. Talk to your advisor before making any decisions. Thanks for being here this week, Bruce. That's the
My pleasure.
That's the
My pleasure. Good to be here.
That's the Raw Naked Truth. You can catch every episode of The Raw Naked Truth at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.